Let me ask you a simple question. If you were, let's say, a professional athlete, would you hire a coach who had never competed at the same level you're at? Or if you were building a large commercial project, would you go hire an architect whose entire level of experience was maybe building small residential homes? Probably not. And yet, what I see are many investors end up taking financial guidance from people whose world looks very different from theirs. Now, this isn't about criticizing advisors. There are good financial advisors out there, but there's a structural reality most people don't want to talk about. As your net worth grows, your needs usually change faster than the traditional advisory model does. Now, what most wealth management firms are built to serve are the masses. They operate on standardized portfolios with standardized processes, and that generates cookie cutter solutions. That works well for a lot of people. But when you start dealing with significant tax exposure, business income, liquidity events, and multi-million dollar portfolios, the conversation usually needs to shift. And at that level, investors just aren't thinking about capital preservation. They start thinking about tax efficiency, the real asset exposure, and more intentional capital allocation. And that's where I often see the gap begins to show up. Now, the first issue is what I call the experience gap. Many traditional planners, they operate inside a very structured system. They work with model portfolios. They use products that are approved by their firm, and they follow compliance frameworks that are designed to keep everything standardized and very predictable. And there's nothing wrong with that, but it also means they rarely operate in private alternative assets themselves. Most of their experience comes from public securities. These are assets that are on Wall Street, and it's asset allocation theory and portfolio construction models. Meanwhile, many successful investors built their wealth in a completely different way. You see, they understand ownership, they're business owners, or they understand leverage and debt. And they understand that value is often created by solving problems, not just holding on to assets. So when those two perspectives collide, friction can occur. Not because anyone is wrong, but it's because they're operating from totally different lived experiences. The second issue is access. Public markets at Wall Street, it's very efficient. Everyone has access to this same exact information at roughly the same time. You're competing with institutions, algorithms, massive capital flows. Private markets work differently. Many of these opportunities that create long term wealth, things like private credit and commercial real estate, operating businesses, these things are relationship driven. They tend to circulate inside networks before they ever appear on some platform. Institutions and family offices, yeah, they often do get to see them first. That's just how the ecosystem works. So if an investor wants exposure to those opportunities, it usually requires either some very deep relationships, a significant amount of time sourcing deals, or participation through a structure that already has those connections. Now, at this point, many investors say, okay, I'm just going to go find these deals myself. And you know what? You absolutely can. But the reality is that properly vetting private investments is extremely time intensive. It's not just reviewing a deck, it's verifying the sponsor's track record, validating the sponsor's background, stress testing the assumptions, understanding the debt structure, reading legal documents, comparing opportunities across all these markets and operators. That's a serious workload for the average investor. And most successful professionals already have a full time career or they're still running their business. So, what often happens is these investors either take more risk than they need, than they realize, or they spend a huge amount of time trying to evaluate deals without the right support. Now, I ran into this myself early on. I tried everything. I read everything. I was on forums absorbing the information. I was comparing all these deals. And what I realized pretty quickly is that private deals have too many moving parts for any one person to be great at evaluating all of them. You've got underwriting, legal structure, market dynamics, operator execution, tax implications, exit timing. Nobody is naturally strong enough in every category to do it by themselves. And I realized that if I tried to do this on my own, I was going to miss something really important, or I was going to remain frozen and never deploy my capital with any confidence. So instead of trying to become an expert in everything, I leaned into something else. I focused on being in the right rooms with the right people, people who were stronger than me in certain areas, people who had already seen what goes wrong in deals, people who understood underwriting or the legal structure at a totally deeper level than me. And what I noticed was that the investors who consistently felt the most confident in those deals, they weren't chasing all the deals. They weren't chasing the most deals either. They were positioned well inside deals. That's when it really clicked for me that private investing, structure matters just as much as the deal itself. Now, because structure determines how your capital behaves once you're inside, it determines your flexibility, it determines your exposure, it determines whether the timeline actually fits your life. And it also determines whether the experience feels aligned or you're in this deal and there's all kinds of friction and it just doesn't feel right. This is also where the idea of aggregated capital comes in. For decades, larger investors have pulled capital intentionally to gain better positioning inside opportunities. So when capital moves at scale, it can change economics, due diligence depth and alignment with operators. Instead of writing one small check at a time, investors participate through structures that allow them to invest at a different level of leverage and access. That doesn't eliminate the risk, but it can change how deals are evaluated and how investors experience the deals. That's really the philosophy behind how I'm approaching investing today. I don't try to operate assets myself. I gave up on that a long time ago. I focus on allocation, I focus on those relationships, and I focus on being in the rooms where opportunities are evaluated deeply before capital ever moves. And I focus on positioning my capital in ways that match how I need it to behave, how I need the money to perform. Now, here's the bottom line: as investors grow in wealth, they usually reach a point where the default model doesn't fit perfectly anymore. It's not about abandoning their advisor, it's about expanding the toolkit. It's about adding exposure to private markets, real assets, and more intentional capital allocation strategies. Now, if you're interested in how I personally evaluate opportunities and think about that structure and decide where my capital should go before I invest, I share that perspective with investors on my email list. There's no pitches, just how I think about positioning capital intelligently. If that sounds useful, you can join below this video. Hey, I hope this was of some value to you. I'll see you on my next one.